I'm watching the replay of the press conference given this afternoon by Fed Chair Jerome Powell after the FOMC, Federal Open Market Committee, announced that they are again raising interest rates, this time by 0.25%. So we're now in a range in the Fed funds rate between 4.5 and 4.75%. During the press conference, Steve Leisman from CNBC asked a very interesting question, and Fed Chair Powell gave a very interesting answer.
Steve Leisman, CNBC. Mr. Chairman, the SEP has the PCE inflation rate in 2023 at 3.1%. Meanwhile, the 3-month annualized PCE is 2.1%, and you've achieved this without going to your 5.1% funds rate, which is what you have penciled in for this year.
Right.
And you've also achieved it without the 1 percentage point increase in the unemployment rate, which you have penciled in for this year.
Okay.
I'm wondering if you've considered the idea of whether or not your understanding of the inflation dynamic may be wrong, and it's possible to achieve these things without raising rates that high, and also without
response,
without the surge in unemployment. And specifically, I wonder if you might comment on the speech given by Vice Chair Brainerd, who said, to the extent that inputs other than wages may have been responsible in part for important price increases for some non-housing services, an unwinding of these factors. In other words, it may not be wages, the idea that it may not require unemployment rising to get this sector of inflation under control. Thanks.
Yeah, that's a great question, Steve. Let's hear what Fed Chair Jerome Powell has to say about that.
Overall, though, my own view would be that you're not going to have a sustainable return to 2% inflation in that sector without a better balance in the labor market.
The sector he's talking about, by the way, is the non-housing services sector.
And I don't know what that will require in terms of increased unemployment, your question. I do think there are a number of dimensions through which the labor market can soften. And so far, we've got, as I mentioned, in goods, we have inflation moving down without the softening in the labor market. I think most forecasters would say that that unemployment will probably rise a bit from here, but I continue to think that there's a path to getting inflation back down to 2% without a really significant economic decline or a significant increase in unemployment. And that's because the setting we're in is quite different. The inflation that we originally got was very much a collision between very strong demand and hard supply constraints, not something that you really have seen in prior business cycles.
Is it possible that the other factors, is it possible that it's this? $5 trillion in pandemic stimulus money? I mean, we haven't seen that in prior business cycles, but I'm going to suspect that caused an awful lot of our inflation. What do you think?